that phrase in 2012, and unfortunately, silver prices dropped almost the day after I made that prediction. So I was wrong for 14 years. It took a lot longer than I expected it was going to take, and it was really based on supply-demand fundamentals. When I put the company together back in 2002, silver was trading around $5 an ounce, and I looked at all my buddies buying cell phones and everyone buying computers, and I came from a copper company. I left a big copper company in 2000 that I put together in 1992, and so I'm kind of already in that headspace as being a supply-demand guy and loving copper. I didn't want to be a gold guy, so there's too many players in the gold space. So silver was a very unique metal to me. It was a huge supply-demand fundamentals as far as I was concerned. I predicted $50 silver when I put the company together, and I was right. It took, again, that was 9 years it took to get there. But it collapsed, as we all know, down to around the 12 range, and then it's kind of stayed, in the trading range for a bit. But we saw industries continually gobble up the metal, industry after industry, whether it's photocells or electrovoltaics or computers or now AI and now nuclear energy, a big driver, as we go through this new nuclear renaissance on a worldwide basis. And, just simply as we, electrify the planet. And, I came up with the phrase, copper's the highway, silver's the glue. Without silver, nothing works. So, even this call today would not work without silver. So, people are starting to understand it. And when the U.S., called silver a critical mineral in middle of 2025, that was really kind of the beginning of the bull run. And I think a lot of institutions, a lot of investors woke up because, historically, and because you've been around this space for a long time, people tend to call silver the poor man's gold. And I've always looked at them as totally different metals. I look at gold as being money. I look at silver as being a strategic metal. And I called silver strategic years and years ago. I forget the year I brought that or made that phrase up. But, now the U.S. government calls it critical. Canada is now going through their federal review on metals. They're supposed to be published something in early 2027, I understand. And there's a move there to get silver put on the Canadian list. Obviously China views silver as a critical metal as well. So, silver is just becoming, more mainstream and not gold. And I think that's really what we needed. And that's what I think ultimately will take silver to triple digits, in the 200-300 range. I don't know how long it's going to take. It took me 16 years to be right, or 14 years, I guess, to be right on my triple digit prediction. So I'm not going to tell you when I think I'm going to see much higher prices, but I do think it'll happen.
The story around silver has changed a lot in recent years. Gold tends to be seen as money, but silver is increasingly being treated as a strategic industrial input instead. It's a key component in solar panels, electrical systems, data centers, AI hardware, and advanced energy technology. And the broader push toward electrification and renewables has only reinforced that role. Analysts now talk about silver less as a store of value and more as essential infrastructure for the digital economy. Governments have taken notice too. The US and other countries have expanded conversations around critical minerals in recent years, pulling silver further into mainstream industrial policy discussions.
Well, I hate government interference, so I look at it as a negative. When governments start using taxpayer money to invest in businesses and interrupt supply chains and compete against commercial operations, I think that's a negative. You could say, oh, it's great that the U.S. government is going to buy metal and put it in a warehouse. Well, okay, fine. If you're of that viewpoint, fine. I'm not. I think government should step away and let industry deal with their own supply chains. And governments have, generally speaking, have made the supply chain more difficult than not. So, no, I look at that as being negative. Well, look, I don't want to get too much into politics here, but, when governments invest in businesses, they're generally wrong. They'll invest in the best promoter, Someone that may have a project that is maybe not bankable or financeable in any other normal course way that most mining companies raise capital. If they have to go to the government on their hands and knees to try to raise capital, it's generally a marginal project that the industries themselves have set aside as not being a viable project. And so whenever the government puts money into any business, I don't care if it's mining or not, it generally fails. And I think those investments will ultimately fail. Yeah, we're right on target. 50% of our guidance that we put out, well, actually, we put out our guidance twice a year. We did our January guidance, and we upgraded that guidance in July of this year, which is normally what we do. Our guidance in July was 10% higher than our guidance in January, so that was a good sign. The shareholders, the market liked that positive news, and we're right in the 50% mark is exactly where we should be. So, we're producing a lot of silver, a lot of gold right now, and our target is around 32 million silver equivalent ounces for 2026, and of that number, about 55-60% is silver, about 30% of that is gold, and a small portion of that is in the form of lead and zinc. So yeah, we're very focused on silver, but we do have some gold in the portfolio as well. Well, it first started off with institutions. I think there was a lot of industrial buying as well that came into silver, because I think when the government did come out and say, silver is a critical mineral, I think that it probably made some industries nervous, and because that was probably the last thing they wanted the government to say. So, there was, some initial buying that came in commercially. We were contacted on a number of occasions ourselves during that time frame. And then, once the move started to happen, the institutional money started coming in. That was that big run, on the long side, from call it October-ish to, December. And then really after that, in come January, it was profit taking and short covering. So that final move from really kind of the $90 range to 120, call it, that was all short covering, and there was a lot of pain out there. A lot of banks were losing money, a lot of institutions were losing money on the short side. And then, once the buying ended, everything, as we know in the markets, what's called, by traders is buying exhaustion, where you just, there's just no buyers left, and you do run out of buyers, and just normal fact of how the markets work. And when that did happen, obviously the big funds out there, can recognize that, because they follow this stuff very, very closely, and they just whack the market, and within a couple of days. And this is the paper market. This is not the physical market. Physical market did not change. It remained in tightness it's even tight today. But they regained control of the paper market, and they remain in control today.
One of the more contentious issues in the silver market is the gap between physical supply and paper trading. Mining output represents just a fraction of the volume that actually trades hands through futures contracts and other financial instruments. Critics argue this creates outsized leverage, letting prices move independently of what's actually physically available. Supporters push back, saying futures markets provide necessary liquidity and efficient price discovery. That debate got louder after stretches of heavy institutional buying and sharp price swings. Industry data shows physical inventories have stayed relatively tight even during periods when paper markets saw major corrections, underscoring the gap between financial trading activity and actual industrial demand.
Yeah, I like to see more of a uranium type of market, where there is kind of a spot market, but there's more of an industrial participation, where the industries on both sides are working together with each other to supply, silver, of course, and then that exchange, call it, is just a benchmark of what the price may transact at. And the price, can change depending on jurisdiction, transport costs, all the, kind of logistics that it takes for a mining company to get that metal to the end consumer. So, and that's what happens to the uranium business. And, rather than, having, this paper market traded, pretty well 2 billion ounces of paper silver trades a day, which is crazy just thinking about that. When the mining sector itself, only produces 850 million ounces per year. So, do the math, call it 320 trading days a year, and, multiply by 2 billion, divided by, 850 million, you see that there's leverage of something like 400 to 1, which is pretty crazy. And yet the mining sector allows it to happen. That system's been in place since the mid 70s, and the reason why it's still in place is because it's easy. For us as a mining company, we know what we're going to produce, and obviously we sell metal. That's our job, getting it out of the ground and selling it to industry. And we pick up the phone, talk to a trader in New York, and we have relationships and say, okay, sell 200,000 ounces at $60, and it's done on the phone, within seconds of that call, and then we can have that check in our bank within 2 to 3 days. And there's no sales force. All of a sudden, in the uranium sector, they do have to have a bit of a workforce that actually works on sales, and I don't see a problem with that. Knowing your client, knowing where the metal goes, and all those types of things, I don't look at that as a negative at all. That's actually what I'd like to see happen. But the big mining companies, it's just an extra layer of complications in their business that they just prefer not to do. So it's just easy for them to deal with the banks and get paid, and they don't have to worry about where the metal goes. Well, it would take 10 First Majestics to fill that deficit, and that's not going to happen. You look at the 10-year chart, and it's available on the Silver Institute's website. Actually, you can look at our website, and if you go to First Majestic's corporate presentation, you'll see a chart on second or third or fourth page of the presentation, and it shows you 10 years. And silver productions fluctuated in 2016. So the mining sector produced 880 million ounces that year. During COVID, 2020, it dropped to 780 million ounces. Today, it's 830 million ounces. So if it's basically flat line for 10 years. It's, anywhere between, 825 to 850, call it, every year, same as it, and it's not going to change. And there's lots of reasons why, if you want to talk about it. But, currently, under the current environment, it's not possible for the mining sector to produce more than they're currently producing.
Despite higher prices, global silver mine production has grown surprisingly little over the past decade. Finding a deposit is only step one. Companies then need permits, infrastructure, skilled labor, financing, and the ability to survive multiple commodity cycles before a mine ever produces anything. In remote areas, the challenge compounds further, since roads, power, water, and ports may not even exist yet. These projects can take anywhere from 10 to 20 years to get off the ground. Industry leaders argue the real bottleneck isn't geology. It's capital, regulation, and long-term confidence. As a result, supply growth has consistently struggled to keep pace with rising industrial demand.
We're a mining company. We're obviously part of the mining industry. So, we have assets in jurisdictions that we trust and are happy to work within. And, we places like Mexico and, many parts of the United States, many parts of Canada, Australia, some parts of Europe, some are problematic, but some parts of Europe, some parts of Asia, but many are problematic as well. As a mining company, you want to have land tenure and low holding costs, low royalties, if any, hopefully low tax rates, access to employment, access to people, and often vast amounts of people. Or you have to build the infrastructure to, house those people, and then the permitting that comes with it all. So it takes multiple years, after discovery, to get a permit. And it's not just one permit; it's multiple permits. You need permits for drilling, you need permits for development, you need permits to break ground, you need permits to build the mill, you need permits to hire people. There's permits along the way, and it takes a lot of time, a lot of money. And it's a huge hindrance. So, if you discover, a mountain of silver, in, the Andes, 14,000 feet above sea level, how are you going to get at it? There's no electricity, there's no people, there's nothing. There's no port. So, even if you were lucky enough to find an asset like that or a mountain of silver like that, the years it would take, the amount of money it would take, and who's going to make that investment? The mining sector doesn't have the confidence in governments. It doesn't have the confidence in the cyclicality of the metal prices, because if it takes you 20 years from start to finish, from discovery to first pour, there's a lot of money, and you've got to live through a lot of cycles, and the management team pretty well has to stay intact. The investors pretty well have to stay intact. So, you're dealing with long-term investors, long money, and, as well as I do, all the institutions of the world, they don't look at 30 years or 20 years or 10 years. They look at, 1 quarter or maybe even less, 1 month. So it's hard for them to conceptualize, what it takes to get a mine actually operating and getting metal to the ground and into industry. So, that's the problem. And that's why the sector currently today can't produce an ounce more silver than it currently does. Well, I think they already do to a degree. China, much of the Middle East, much of Asia, Russia up until, the current conflicts, were big buyers of gold and many have continued to buy gold. And India, China, continually buy vast amounts of gold. So, that's created not only a bid in the industry, like a bid on the price of the metal, because they're consuming. I saw some numbers that it's 30% of annual production was purchased by the Chinese, and so far to date in 2026. Whether that's a correct number or not, it's a number I did read. So. That's a lot of silver, a lot of gold, going to one buyer. And if you add up all the other buyers around the world, and they're all central banks, that number can easily be north of 50% of the gold just going into central banks. And that's pretty interesting. That did not exist a decade ago. So, that creates a floor, in the current price of gold. And then the upside, of course, is other things like investors get excited, investors that want to put gold away, in permanent storage, for protecting their net worth, their family net worth, become buyers, and we're seeing that. So, yeah, I think to your question, it's already happening. Well, it hasn't affected us. There is what we call NAFTA over here. Which is a trade agreement between the United States, Canada, and Mexico. Under the current administration, they don't seem to think it's worth the paper it's written on, but nevertheless, it does protect, industry in North America to some degree. And when there was some rumors, I guess, a year ago or maybe longer now, that there might be a tariff put on silver and gold, that was quickly rebuffed, because that did show up in the internet, and there were some posts I saw on X about that topic. Yeah. And within days of that, the U.S. government came out and said, no, we're not tariffing gold or silver. Okay. So, that's I would have been surprised if they would have done that, because, the United States is a huge importer of silver. They don't currently produce enough silver in the U.S. to actually feed their industry. They've got a lot of window manufacturing, microwave ovens, freezers, you name it. The U.S. produces a lot of stuff that requires silver. And so for them to put a tariff on it would just be shooting themselves in the foot.